Ladies and gentlemen of the crypto space, we're live on a Monday, November 13th at 12:33 p.m. A little late today. Was talking with some colleagues. We're going to probably plan some additional streams coming your way over the coming weeks and months, maybe a new pattern. Try and be a little bit more consistent with getting content out other than just on my stream. Get some other conversations in the group other than my notorious monologue. But that's what you guys are here for, the monologue, to hear me talk what's on my mind. But that could get tiresome, I guess. I don't know. We'll figure it out. We'll figure it out. All right, let's pop up the screen and let's talk about the mean. What do I mean? The mean regression. So the market looks interesting. Notice that we're at resistance. Resistance at least relative to March-ish, March, April. There's a Q2. So we hit resistance back in August of 22. Need to have decent time frame to understand where the heck we are in the market. So this was a resistance expression. So going forward, we look for resistance expression at that level or support at that level. So we had a breakout. We had hopes, and it failed. But it came down in a one candle sprint to the downside on a daily candle, break right through. No expression of support whatsoever. We had another retest shortly after. No breakout, no just complete resistance. Same thing over here in July of 23, complete resistance. We had a breakout a couple of days ago, about a week at this point, and we have expression of support. So we have an expression of support, whereas back here, it was a butter knife through in April of 23. There was no expression of support whatsoever. It is different right now compared to earlier times in 23 and later times in 22 when it tried to get back to this level. This is a very interesting state of the market considering macroeconomics. There's all the reason in the world for Ethereum to break out and have a nice short liquidation cascade, push us up into 23, 24, 25 region, and then you'll obviously have mean regressions from there. Bitcoin certainly has a capacity to mean regress from here, at least to the time weighted average price. Let's block the super guppy. On the daily, you could easily see a mean regression to 35,700. Go out to the weekly, you can see plenty of mean regression down to 29,000. These are the types of mean regressions you would see if there's fear in the market, and the fear in the market was cascade from traditional equities, maybe Forex, maybe even the bond market if we have a move blowout. But move has been relatively suppressed for the last couple of weeks, which is calming markets. As move calms down, systemic liquidity calms down, and market volatility calms down. I don't foresee necessarily monthly mean regressions. Those would be significant depreciative events. Clearly, there's a time-weighted average price here, and these are relatively free markets compared to traditional equities in many regards, being that governments are dependent on revenue, government, tax receipts. So those markets are supported from a liquidity perspective, even indirectly. Worst case scenarios, we do see mean regressions to the 25.9 region, but 25.9 is an incredible number, all things considered. 25,007.9 or whatever. $25,000 for a Bitcoin compared to where we were in 2019. Remarkable numbers where the average price is. I want to be looking for, even the 3-month, it would be in the 30s. So the monthly mean regression is actually much lower than the 3-month mean regression. So 25 on the monthly, and on the 3-month it's actually higher. That's actually an interesting observation. It's inverse to what one would expect. But this is generally the trend that I would expect to play out. We could see a dip below, and that would be like a regression on the monthly or the weekly. But this is the trend. So for instance, you see a mean regression to 25,000. If you hide the price action, you would expect about 3 months after that mean regression, you'd probably be back at around 30, 31, 32. That these are quarter candles on this chart. So where are we with regard to markets? Bitcoin had a nice rally, a breakthrough, 3 months time weighted average price, a breakout, and it ran first, which is historically the case given its macroeconomic significance, concept of collateral, concept of can you access Bitcoin versus maybe you can't access dollars. So that is certainly a narrative that is spreading across the planet. So Ethereum has not run yet as expressed by Ethereum denominated in Bitcoin. Ethereum outperforms Bitcoin pretty much always. Bitcoin moves first, and Ethereum has catch up to do. Notice, and you can see that vis-a-vis the average price. And the average price from a 3 months perspective indicates that Ethereum has yet to do what it is expected to do from an average price trend momentum direction. So Ethereum is still at a discount relative to the Bitcoin price movement. So what you're seeing in many regards in price action is a rotation of capital from Bitcoin to Ethereum, which is why you're seeing this wick. We haven't seen enough capital inflows into markets to say Bitcoin and Ethereum are rallying together. I would account a lot of this price action to rotation of capital from what was outperforming to now something that is yet to significantly outperform. So my expectation is probably a short to midterm breakout for Ethereum into 21, 22, 23. 2140 is the line to breach. Notice you have the 10 SMA on the 3-month chart right about here, which is the 2140 level, more or less. If you zoom in on the daily, if you compress and scale, you can see 2140 is those previous tops back in April and the last couple of days this past week. So a breach of 2140 will get us going from a 10 SMA on the 3-month chart perspective. Here's zoomed in, and there's your 2100. So 2140 is there, and a breakout above 2140 would be finally a confirmed break of the 10 SMA in the 3-month. I think we're nicely positioned for this to occur over the next days or couple of weeks, barring an interruption in systemic liquidity. It's not like there's going to be a narrative invalidation. This is a rotation of macro capital. Everything has had a significant run. I follow Adam down here, Dot, Solana. So just expect the mean regressions. I mean, me talking to you guys on this stream, we've been in the markets. We have these assets. We bought bottom. You had to pay a premium to buy bottom. And that premium was being allocated to markets during significant depreciation. And that's a tweet that I've said a couple of times probably. I was willing to pay a premium to be exposed to these markets when they bottom. So now that's exactly what we've experienced over the last couple of days and maybe a week or two. A significant price action movement off of the bottom. So I'm very happy I paid that premium because this has been nice to be exposed to these markets in these conditions. I think this is obviously just a taste of what's to come. We keep an eye on macro to see whether we're going to continue from here. But look, even we have a mean regression playing out on curve. Zoom into the 4-hour. Give you some perspective here. And there you go, mean regression to the 50 SMA on the 4-hour. Support, which is nice to see. But look what happens. Look how deviated you get away from average prices. Break through the time-weighted average price. Support right on the 50 SMA. Go into the daily. Support right on the 10 SMA from a daily chart perspective. And clear resistance on the 50 SMA. Isn't it nice when you see everything from a moving average perspective? It's like, oh, you'll see a dangling candle in one time horizon, but then you'll see, okay, bam, someone smacked by right on the 10 SMA of the daily. These average prices are baked into algorithms. These average prices are baked into traders and people that are actually looking at these charts, just as we're looking at them right now. And people are waiting to buy at some sort of reasonable level. And the level that they buy carries momentum into other actors in the market to do something similar. Clearly, this could have occurred on the time-weighted average price of the daily, but this was the average market actor saying it was the 10 SMA of the daily where support would be expressed. We are significantly deviated from the time-weighted average price on the weekly. Curve has been outperforming with the higher high and has thus far, with this current week's candle, been trying to put in a higher low. We are on 6 days and 7 hours left. This is literally just the start of the week, so we are very early to seeing where things are heading from a weekly perspective. But this is not necessarily, you can't get ahead of yourselves in markets. Like Convex was pushing towards $4. There's resistance above head. You got the 50 SMA on the weekly. Zoom out to the monthly, which literally coincides with the 10 SMA on the monthly. And if you zoom into the daily, you see it's very nice. You're above the 200 SMA. So what happens when you're above certain moving averages on the shorter time horizons and you're below some resistance on the longer time horizons is this is when markets are deciding. They're deciding where support is going to be put into the market, where you can have crab action, horizontal price action for folks that are in profit to liquidate and folks that wanted a position on a minor pullback to get into the market, and things go horizontal for a period of time. I think the directionality is comfortably appreciated from here, and this is the type of chart patterns that are indicative of higher lows and higher highs over time. Where's the yen at? So the yen has been coming back down. They're obviously offloading their there's a bid on treasuries. That's comforting to see. It's comforting to see the yen retrace, considering they got to sell their savings, which will put sell pressure on the long end. Yet we're seeing a bid on treasuries simultaneously, which means the market is absorbing the sell pressure of Japan as they need to support their currency. This is all kind of consistent with a relatively healthy bond market, and a healthy bond market is required for systemic liquidity, and systemic liquidity is required to see stability in risk markets. You can't be afraid that currency units are going to be needed. You can't be afraid that interest rates are going to change significantly. And when interest rates are relatively stable for a period of time, systemic liquidity becomes supported. And that is a forward-looking indicator for the market to feel the comfort required to allocate capital to investments. DXY pulled back from 105.8. This might also be producing buoyancy in the market. Resistance on the 50 SMA on the daily, which is quite nice to see. If I zoom out, I've circled historically where our crypto bull market cycles have been and their periods of dollar weakness. Let's do that for you guys. If you zoom out to the 3-month chart, our two bull markets, the entirety of anything anyone would ever define as a crypto bull market, let's not do a circle, let's draw it, was right here and right here are these downward legs in the dollar. For the dollar to come down, it means oil needs to roll over, and oil has been bouncing off of the 3-month time weighted average price. Undo. Zoom in. So this is why, to really get a sense of directionality, you want to look at oil as a leading indicator on the dollar, and you want to look at the pressure the dollar places on foreign currencies as a leading indicator on the bond market. And obviously, Treasury issuance is causing all sorts of distortions as well. But seeing the bond market bid is certainly comforting from a systemic liquidity perspective. You want to see this. You want to see down on rates. Frankly, you want to see stability on rates, which is expressed by the move indicator. But you also want to see appreciation of the treasuries, the long end of the U.S. debt market, and that will indicate that there's support for systemic liquidity. Eyes on China as well, but we're not going to get into that right about now. Look at this volatility suppression in U.S. equities. VIX is down at 1478. Gasoline has hit support on the 3-month 50 SMA, but if you zoom in on the monthly, plenty of support as well. Where's that breach that I was looking at? So there's potential for gasoline to roll over. It breaches the 200 SMA on the weekly, and we could see continuation to the downside. Notice support is a position of weakness. It's not a support expression of strength. Let's go out to the 3-month. What you want to see is a breach of the 50 SMA to the downside. This is the moving average I was looking for to talk to you guys about. Time-weighted average price on the 3-month, which is nice that it is below it. What you want to see it do is hold as resistance. 3-month candle, 1 month, 17 days left in the candle, and you want to see the inevitable breach of the 50 SMA to the downside. If gasoline moves towards the 100 SMA in the 3-month, you'll see oil roll over, and that may be enough momentum to push it through some of these moving averages. You get oil to the downside of this triangular compression, which is like a 20-year triangular compression, and you'll see the dollar roll over. The dollar rolls over and crypto markets are going to rally hard. So that's why we look at these macro indicators to get a sense of where we are in the cycle. We'll have a lot of technical details to get a sense of where we are at the top of the cycle, heading into later Q4 2024, and what happens in 2025. So we'll have a good sense of when we're able to rotate our cash position from an FX management perspective. As I talk about Bitcoin, Ethereum, and stablecoins as the cash position of the portfolio, we'll be able to manage that according to FX market conditions. I define Bitcoin and Ethereum as part of the FX market. Total market cap of all crypto, excluding Bitcoin and Ethereum, looks very nice. Notice we are still at a discount compared to the 3-month moving average, time-weighted average price. If you zoom in, we have been breaking resistance levels. We are at the point where I'd say on a weekly chart, this 100 SMA on the weekly is one heck of a resistance level. You break this to the upside and you pop past August 2022 and upward we go. Certainly from the monthly perspective, that would be consistent. But notice we have a long way to go to get to the 10 SMA in the 3-month, but notice how deviated from the monthly moving averages we would be if we start to break out significantly. Then we could start to see mean regressions. What will be nice, what I would like to see is a more healthy chart. Notice the deviation in the bull market post 2020, post Q2 2020. Completely deviated from the monthly time-weighted average price all the way up. A more healthy market would be mean regression to the time-weighted average price. And then it would be more sustainable and less likely for a failure of the average price expressing support. And that's exactly what happened here. And we have the deviation of the price action, in this case, the market cap, to the downside significantly, ultimately finding support on the monthly 50 SMA. All throughout 22. That's the bear market. Deviation of price to the downside. But watch as you zoom in on the average price and turn off the price action, highlighting just the average price. We could hide the SMAs. And you have this nice chart. All these markets are up only. on the appropriate time horizon. So the bear market that everyone talked about in 2022 and 2023, you still had an increasing average market cap of altcoins. You see what I'm saying? Time horizon is a hell of a drug. Tapsy's in the house. Not going to lie, we need to figure out a way to get 5 streams a week. I think I'm going to end up settling on 2 streams a week for myself, and I think I'm going to try and get a collaboration in with another crew. That'd be nice. So it's not just the monologue, it'll be a bit of a banter back and forth. George is in the house. There should be video. I think the stream is working good right now. Oh, that was probably just the intro screen. You haven't been around much, but I start with these intro screens nowadays. Hope everything's well. It's been a bit. Drew, hello, Gazika, Sergio, Dan, Killis, Crypto Jake, Trevor, Crypto Mass, Kazan, One Curious View. Tapsy, my native currency is euros. When managing cash position at the top of the cycle, I wonder what smart when it comes to managing dollars versus euros. We'll see in the charts, I am sure. Yeah, I don't talk about it much because it may just be best to operate in terms of dollars. But clearly there could be opportunity to cycle between dollars and euros. We do keep that chart over here. Reset scale. Average price. So interestingly enough, on average, the dollar has been appreciating against the euro since 2010. That's from a 3-month perspective. If you zoom into the weekly or the monthly, you'll see it really started in 08. So the dollar has been in bull mode. You get a sense from DXY. And we'll zoom out to the 3-month and we'll put the price action back on. Dollar has been in bull mode since January of 08. So Q1 of 08 on the 3-month chart. Will we see a top? Will we see a secular rotation where the dollar returns to what it did in 2000 and what it did in 1985? I kind of think so because that's how the system works. Either you provide the system with adequate dollars or this kind of market dysfunction occurs. And what does that mean? That means they're issuing a crap load of treasuries. It's not really treasuries, it's the short end, and that's what Yellen has been opting for because of rates, obviously. But there's a huge amount of refinancing that's required in 2024. So the system is going to be flush with collateral in 2024. So the euro-dollar market, if rates remain stable and the move indicator finally rolls over and rates on the long end finally stabilize, the system will be flush with liquidity. But it'll be dollar liabilities. It'll be the euro-dollar system. So what historically happens is that's leverage. So how do you stabilize a system that is using collateral to print dollar liabilities to leverage the collateral? Because the system is starved for dollar liabilities and everyone is making their dollars instead of buying their dollars on FX, is that the US needs to increase the base supply of money. And that's kind of what they did in 2020 and significantly increased M0, which is not printing money necessarily because that money was already printed decades ago in the euro-dollar market. So really all they did in 2020 was deleverage the system. I argue the biggest distortions we've seen in the market was because of the dissemination of capital to the real economy. And clearly that has a whole conversation about it. But going forward, they're clearly going to want to restrain excess capital from getting into the real economy, which has the negative overtones of people having less money, which is horrible. But they're going to need to get those dollars into the financial economy to deleverage the euro-dollar system, which is going to go absolutely ballistic after they print 10.8 to whatever deficit they run in 2024. Usually 13, $14 trillion worth of treasury is going to enter the market in 2024, fresh on the run. Eurodollar market's going to go buck wild. So they're probably going to want to deleverage that. So M0 will go up, and they'll want to get this chart to go down. Financial economy is not the real economy, and it is governed by different rules, particularly whether how much risk they want to take for the dollar liability, the global dollar market, to have some sort of systemic event, some sort of liquidation cascade. And that is where you would have significant deflation. Not just the that's what '08 was. It was a threat to the global dollar market, so they intervened to prevent the dollar liability regime from collapsing. The whole world doesn't operate on dollars. The whole world operates on dollar liabilities. That's the market that emerged in the 50s with the Eurodollar system. And that is the market that must be protected in order for the system to continue. So they will increase M0 accordingly to deleverage that market to fit within the risk parameters that folks like the IMF and the WEF set or observe with regard to stability. Hope that helps. Hilda, hi. George, any interest in FXN? Yes. Yes. I think it is part of the Federation. It is doing very well. I think it will pay because it is an LSD derivative, so it's clearly got an interest rate and a cash flow associated with it. Do I need to own it? No. Do I want to own it? Yes. Do I own it? No. Is that bad? No. Does it mean that other folks shouldn't own it? No. Would I say other folks can consider owning it? Owning it? Sure. What I would implore everyone to always consider is diversification versus concentration, over allocation to a particular narrative. Do you already own things that are part of that kind of ecosystem that are attached to that part of the market? That is the only consideration. Otherwise, it has been doing well. From a price action standpoint, you must always consider how deviated from the mean you are. Are you paying a premium or are you buying at a discount? For instance, if you're buying Bitcoin, you are literally buying at a premium right now compared to the 3-month average price of Bitcoin. You want to buy at a discount, which is where most fear is in the market that somehow the narrative is being invalidated. And I don't subscribe to that. This is at a premium right now. So you will continue to deviate to the upside relative to the average price in the coming months and years. And then you get bum, 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 the mean regression. And if you deviate significantly above the mean to the upside, you deviate significantly below the mean to the downside. So look at that. 6-month you can't really go by because Bitcoin has never breached the time-weighted average price to the downside, at least in recent market cycles, and frankly, the only market cycles that actually count. If you go over to the weekly, it's too granular. There's too much noise in the weekly chart, in my opinion. Look, even the monthly set up for a nice mean regression to about 25,000. 3-month from a Bitcoin perspective. Ethereum, you could also go by the 3-month. You're at a bit of a premium on the 3-month chart. You are not buying cheap Ethereum. You're buying Ethereum at a premium relative to the average price. Certainly from a monthly perspective where the average price is $1,670. So you could expect a $300 to $400 potential decline from a mean regression standpoint. I do expect the market to buy into that. I think there's ample liquidity in the system, even if you have a significant deflationary event. There's still trillions upon trillions of dollars in the system, and these markets are basically zero, all things considered. So that is another part of this market that I think is very different than historic markets. Liquidity in the system is relatively constrained. 2020 was a liquidity cycle. I think 2024 is going to be more of a flows cycle where the narratives of what crypto does from a utility perspective generates capital rotation from other markets to this emerging market. This emerging market is an expression of collateral that offers a capacity to print dollar liabilities, which fits into the overall global monetary system. And it fits in from an emerging market perspective, offering these types of financial products and services. I think there's great reason to expect flows. So 2020, obviously, with the liquidity cycle triggering flows, that's why we saw this extreme deviation from the average price to the upside. We'll see that again, merely because crypto is permissionless. You'll always see the flows. I don't think we're going to see necessarily the liquidity part of that cycle. So in many regards, that might indicate I expect a more healthy cycle. Flows are more healthy than just broad liquidity. Broad liquidity is probably best expressed or likely to trigger a lot of malinvestment, whereas flows will trigger more well thought out investment for things that are really contributing meaningful utility. I'm not sure how the Fed printing reduced the overall leverage. Do you mind expanding on that? So let's say there's $700 trillion worth of dollars in the system. If you go over to M0, there's only $5.5 trillion on the planet. So there's $700 trillion of deposits and dollar liabilities in one form or another, which is literally just credit. The United States general public literally printed over $1 trillion themselves. If you look at the credit card debt outstanding, that is printing money. Credit is the act of printing money. So if there's 700 trillion, let's say there's only 5.56 trillion dollars, actual dollars on the planet. When they increase this number isn't money in the system. The system uses dollar liabilities. When you pay your credit card, you're paying from a bank account. You think you're paying your credit card with dollars? No, you're paying your credit card with bank liabilities, which are literally dollars printed using U.S. government bonds. So all they're doing when they increase this number is trying to figure out a way to deleverage the total dollar liability regime, which is the dollar system that we use. We don't really use actual dollars. So paper dollars is another story. Most people don't use paper dollars. That the vast majority of the system literally just uses dollar liabilities. Hope that helps. Lucian, I like XF and FXN's products in the pipeline. Another protocol under the flywheel of Convex. You hit the nail on the head. It's part of the federation of protocols that are doing what we've talked about over the last couple of years. So I have a high opinion of it. And just because I have a high opinion of something doesn't mean I allocate to something, and that does not diminish any other person's reason to potentially allocate. I like it. That's cool. I don't need to own everything. I can't own everything. In fact, excess diversification is a net negative on the portfolio. Wealth is made by concentrating capital into fewer and fewer investments. George, are you not touching it because you consider it too close to the curve narrative and overlaps with your other position? I have my 2024 rules. I am not engaging in capital gains. I do not want to buy things to sell them. I have a portfolio that consists of Bitcoin, Ethereum, and stablecoins. I define those as the cash position. The other part of the portfolio is investments, things that I own, which means I have no intention of selling them. The investments are attached to the market's liquidity by producing cash flow to add to the cash position. These investments will appreciate in principal. These investments will grow with regard to the amount of cash flow they produce. The cash position of the portfolio I treat like an FX portfolio. You're going to rotate your capital from Bitcoin to Ethereum to stablecoins depending on market conditions, but at any point in time that capital is needed for spending purposes, Bitcoin is cash, Ethereum is cash, stablecoins is cash. I can consume that cash. Investments are separate, cash is cash. And that's generally the structure of the portfolio, the way I think about it. But yes, it's an unnecessary redundancy to how I would allocate capital in the investment part of my portfolio, George. Killis. Two of the many lessons I learned here very early: you can't own everything you want. And two, when you think prices can't go any lower, they do. That is very well said. I wrote a tweet, I swear, back in like late 2020, or I don't, maybe it was 2021. I don't know. I can't find it for the life of me. I swear I wrote a tweet that said that, and I've tried so hard to find it. But that was basically the tweet. It was like, they're going to go low, and then they're going to keep going lower. And I'm pretty sure that kind of played out as most people's experience with 2020 and 2023. But now we're seeing the market turn around, and that's the whole start of this stream today. It looks pretty good. I like what I see from an Ethereum perspective. Anything lower than, I'll get back to the comments, but anything lower than about 20, we need to see this line hold. There's plenty of argument for mean regression. There's plenty of systemic risk in the macroeconomy. And the average price on the daily is literally 1924. But what was a nice observation is what I've labeled on this chart, an expression of support. This is the first time since 2022, and everything started to depreciate, that we see an expression of support at a price level. An expression of support is best when it was a previous expression of resistance. That is a flipping of resistance to support. And that is indicative of a directionality. So this is quite comforting. And literally, this is the last couple of days. This is the first time since everything started depreciating in 2022, January of 2022, really like November, December 2021, that we're finally seeing an expression of support, literally in the last couple of days. Hallucian, I understand how being in a liquid position is a double-edged sword. I'm already considering selling on the way up so I don't round trip everything. I want to own these assets I've chosen. Reasonable statement. Keep in mind, these cycles last years. Higher lows and higher highs last years. You want to see, this is kind of the start of the cycle where things will keep going higher and we'll see mean regressions. So round tripping, no one wants to do. I appreciate that. Also consider the time horizons. And I know I dig into the charts and I dig into the data and I share it with everyone. And everyone, I would hope, can take from what I display and absorb it. But I don't see this as conditions to give everything back. This is kind of the conditions potentially for the start of the cycle of higher lows and higher highs as compared to lower highs and lower lows. Now that might not be the case, but I don't think there's pretty much any capacity that's going to push for lower lows from a yearly perspective. That would be an extreme systemic event. This was big deviation to the downside from a 3-month average price perspective. That was very large deviation to the downside, especially from Ethereum. Bitcoin to a lesser extent. But this was a large deviation. Look at this mean regression. And it's just momentum. You go up, oh, there's too much, it falls over and it falls down, comes up, it'll come down. There's very much a reason to expect maybe 32 and change in a mean regression here, and then it gets higher. Think of a roller coaster. And then it's a higher low, and that's consistent with like a triangular compression in many regards, which is lower highs and lower and higher lows, lower highs and higher lows. How does one play this game during a time of price appreciation? Switch to stablecoins and accumulate a treasury of cash to buy the next low. That's from a capital gains perspective, and that is what I've tried to express from a story perspective over the last 2 years. I don't want to play that capital gains play, and that's when I'm describing the structure of the portfolio. That's me trying to express how I've redefined how I want to play the game. I have a cash position and I have investments, but investments, the definition of an investment is something that is cash flow positive, something that is productive, something that pays you, which in traditional terms would be an equity dividend. In the crypto markets, it's the assets that pay you cash flow. And clearly there's an intrinsic cash flow on Ethereum, but that might not meet expectations. 4-5%. One is underperforming the risk-free rate of return of sovereign debt, and two, it's not very productive. If you have $3 million worth of Ethereum, you're making 150 grand a year. Okay, so depending on your portfolio size, you have different opportunities available. For me, even considering the portfolio size, I'm still looking for significantly above the risk-free rate of return. I'm looking for probably between 10 to 20% APR per year, and that is producing cash. So, investment part of the portfolio, cash part of the portfolio. The structure of the portfolio is completely dependent on the portfolio size. A small portfolio may only be able to have a cash part of the portfolio. You may not be able to have investments that are sufficiently productive to meet your expectations, and that's okay. All of these things, you may have all these terminologies, you may have to rewind to hear the terminologies, but you have to define them. What is your cash part of the portfolio? What is your investment part of the portfolio? How productive do you need the investment part of your portfolio to be in order to justify having an investment part of the portfolio? Is 20% adequate? What is 20%? 20% on 10 grand means you're making $2,000 a year. That's not going to meet the expectations of many actors in crypto markets. Many actors in crypto markets are looking for outsized returns to turn 10 grand into $500,000. You're not going to do that with an investment part of the portfolio, and you would have to engage with the portfolio as if it was a cash portfolio, which is not something I talk about. I talk about a more structured portfolio. There will be a time when I will engage with the cash part of the portfolio and we'll have fun from a technical perspective. That is not currently the conditions that I see. I don't see enough of what I want to put risk on in that way. That's just the way it is. I hope that helps. George, wow, that's so interesting. I guess at this moment you're not pursuing any new plays besides current investments. That's correct. I took on Prisma because it was a large airdrop. Very nice that the airdrop was in a locked position. It was not liquidatable, so it was not income. There was no receiving of the assets to even sell them. It was literally just put into a untouchable position. So that was quite comforting. I like that very much, and that has been performing very well. I like what I see from a price action standpoint. What is interesting about it is that it was launched with convex. So that is like Curve launching with convex. There's going to be a lot of competition with regard to stablecoins. Is it better than other protocols? Not necessarily. Did it launch with all the check boxes? Yes. Convex integration on launch, that was a big checkbox. And off the bat, they're getting Vodium integration, it looks like, real soon, and hidden hand integration. So that will drive a nice stable price. This fits into the bucket of assets I talk about where I don't expect asymmetric appreciation. This fits into the bucket of assets where I expect maybe appreciation during irrational exuberance. If we look at Curve, topped out at $6, and then mean regression down to 30 cents during extreme systemic instability. What I expect out of this asset is relatively horizontal price action from a 3-month average time frame. I expect crabbing. It's not going to do what people want it to do from asymmetric appreciation standpoint. fits into a lot of the income bucket rather than the cash bucket, which we'll play with regard to trading at some point. Hope that helps. Do you consider income from investments cash only with no intention to ever allocate? So, income is income. Income is cash, which means you could spend it on things, pay bills, put it on a debit card, go to the supermarket. Great. You want to accumulate income. You want savings, just as if you had a paycheck. Income is a paycheck, except you're not doing work. You own a business. That's the major difference, but it's still income. If there is an investment opportunity, you have cash, you can invest. Is the investment worthwhile? Do you have enough of a position size for it to be worthwhile? Maybe it's trading. Okay, great. You can pretty much trade with any amount of capital that you have in cash. How much risk are you taking? So that's the trading equation. From an investment standpoint, if you have X amount of capital to invest and you expect about 20% APR, is that an effective allocation? May not be. For instance, $10,000 producing 20% APR, $2,000 a year, a little less than $200 a month. Set the expectations based on the actual reality of how productive the investment is going to be. For me, I'd love to see investments that produce maybe like $200 a week, and that's a very effective investment in my eyes. An extra $800 a month is quite meaningful for the cash position and allows me to do many things in real life. Hope that helps. Brian, happy Monday. Much a pleasure. Kaysen, Aura controls 45% of VE Bow now. I have my Aura position. I really wish Aura would diversify and accumulate additional assets, the same overtone as what Convex is doing. I would love to see other protocols accumulating Aura. The Aura and Balancer narrative right about now is the 80-20, and it being a utility to have a locked liquid governance position. It's meaningful. We need more recycling. We need more sterilization. We need additional protocols to want to accumulate the governance power. And I think that would be a good thing to see. I don't see it right now. So I think there's some things that should change. DeFi Futurist, howdy. Premium means too late to buy. Not necessarily, but it does mean certainly you could see mean regression to a price point lower than what you bought it at. Let's go back to the chart. For instance, buying Bitcoin now, there is no reason not to expect a mean regression to 31,000 and probably a deviation to the downside, 29, 28, 27. That is perfectly consistent with the average price of the asset over time. To get the best discount, you want the deviation to the downside. So these are just simple rules. Ethereum denominated in Bitcoin is at a premium. I think everything's at a premium. I think Ethereum, one, can break out here, and we could see significant deviation from the average price to the upside. So it's not necessarily a statement that it's too late to buy, but it certainly is a statement that you should expect mean regression at some point. Heck, it could break out here and you might not see a mean regression for 2 years. I hope that helps. Not easy, complicated. Kill is Thanksgiving. I look forward to Thanksgiving. Good times with family. I need some time off. Really need some time off. I'm exhausted. DeFi Futurist, how much is a good amount to be able to play CVX CRV? Do the calculation yourself. For instance, you could get, let's say, 20% on average right about now. 20% on $10,000 produces $2,000 worth of income per year. Does that meet your expectations? If not, it's not necessarily a good investment. What is your expectations? Are your expectations reasonable? These are all critical things to define. I myself have below average expectations. I will be selling, liquidating from an FX perspective, Bitcoin and Ethereum well below anything that resembles market top because my expectations are not my requirements. I have financial requirements that encourage me and tell me to liquidate way before any all-time high is even in sight. So define your requirements from a real-world financial perspective and define your expectations from what you want to achieve. And make sure your expectations are reasonable. This is what gets folks into the hodl position, having expectations that are unreasonable or undefined. I'm going to hold. Hold until when? Define it. And then you end up round tripping because you're like, I'm not going to sell it because you didn't define when you wanted to sell it, what your expectations were, and what your financial requirements were. You need to define the granularities. Hope that helps. George, looking forward to exploring similar opportunities. The ice spell, good old times. That was fun times. I don't see much traction for ice. It's just out on the risk, way out on the risk. Spell, I think Abracadabra's positioned very well from a dollar liability standpoint to take part in endogenous liquidity printing in the coming cycles, which literally is heading into 2030. I think their protocol will continue to thrive. Why? Primarily because it survived extreme instability, and that was good to see, and especially in hindsight. Would I allocate to it? Not necessarily. Probably because I don't need to, but it doesn't mean it's not necessarily a speculative, decent allocation. As always, size appropriately. DeFi futures, it's always a pleasure, and these streams will continue. Kazan isn't ice on Kava now? Possibly. Kava, the last couple of thoughts, and we'll wrap up the stream. This is one of the most meaningful pages in all of crypto. Kava is a negative sum game. Capital has been draining, 3.84% for the week. Bear in mind the entire crypto space has been a negative sum game for 2 years. We finally are starting to see the signs of stablecoin stabilization with regard to the total supply, which is a combination of both exogenous flows and endogenous printing. The primary stablecoin activity and growth has been on both optimism as a little bit positive sum, but certainly Solana, 2.39% positive sum on the week. We could click through them real quick and we'll probably see all negative sum. Arbitrum, marginally positive sum. Binance, marginally negative sum. Tron is another conversation. Ethereum is about net neutral, give or take. It's good to see, but all is finally positive sum. Finally see a positive sum for stablecoins across the entire DeFi landscape, which is why we're seeing the price appreciation we've seen. Imagine when you see all at 2%. If all of the price action we've seen is a result of 0.75%, what happens when it's at 2%? That's when you see significant deviation from the mean to the upside. George, do you still see Phantom, the blockchain, as having a future? Yeah, I do. I think there's going to be significant upgrades. Andre being extremely controversial and all is mostly irrelevant. The controversy is irrelevant. I think there's great potential for Phantom in the future. Falls into the category of do I need exposure to it? I don't. I have exposure to Cosmos to Polkadot, and that's about it, other than Ethereum and Bitcoin. And those are like the L1s, so to speak, that I have exposure to. I don't think I would take the Atom position today if it was not currently a position. It is a legacy position that was taken at a fraction of the price that it is currently available at today. Uh, let's do this. Let's move this back here. Let's wrap up the stream in a couple minutes. Eyes on Ethereum right about now, everyone. We want to see it stay above the 2030, 2040 region. If we continue to see support there, it's quite comforting to see from a technicals perspective. And a break above, 2140, 2150, and we'll see continuation to the upside really quickly. We'll see shorts get liquidated. We'll see capital flood into the altcoins as that narrative just gains further support of continuation to the upside. But what do you see right here is all the altcoins mean regressing, and that's what's giving Ethereum the bid. And this cycle will play out over and over again. Bitcoin gets a bump, Ethereum gets a bump, altcoins rally, Ethereum pulls back, altcoins mean regress, Ethereum rallies, and it's just a constant cycle of capital back and forth, but also eyes on obviously endogenous liability printing, which we'll see in the DeFi Llama page under the endogenous dollar liabilities. Frax, DAI, liquidity, now MKUSD, CRVUSD, and that's endogenous dollar printing versus exogenous dollar liabilities flowing into the system. Thank you all for joining. 21 people made it to the end of the stream. 16 likes. I appreciate each and every one of you. Smack that thumbs up button. Tell everyone to subscribe. In the description is a link to the most rational community in the entire crypto space. I appreciate everyone in there surviving the bear market together. I will see everybody later this week. Peace.